What's up, everybody, and welcome to today's JKAM fund overview. I am your host, William Benatti. Special thanks to the Verivest team for hosting and creating such a valuable platform that creates trust and transparency for investors in the private real estate marketplace. The purpose of this overview is to share the JKAM opportunity and why it's compelling for the passive investor. I welcome any questions that you guys may have. So let's go ahead and jump in. Here is our disclosure and disclaimer. For those of you who want to read this, you can look at this at a later date as this recording is going to be, or as this webinar is going to be recorded. So you can go back and read it if you choose to do so. So I'll be doing brief introductions. I'll talk about the Diversified Fund, the investor benefits, fund asset diversification, current fund holdings, tax benefits, how to invest, and lastly, finish up with contact information for any questions or feedback you may have. So let's go ahead and jump in. So for those of you who don't know me, my name is William Benatti. I grew up in Colorado and got a degree in finance and real estate from Colorado State University. Right out of college, I obtained the Series 7, 66, and Life and Health, and spent 7 years in the banking and investments field, and then transitioned into more of an entrepreneurial role, investing in real estate. This started out with wholesaling houses, then flipping houses, and then investing in non-performing loans. And while I was living in New York City in 2014, I connected with Jack Krupe and then joined his team to run his NPL dispositions trade desk. Both Jack and I left that fund in 2019 and have partnered up to form the JKAM Diversified Real Estate Fund. My family and I now live in Vail Valley, which many of you know of or visit from time to time. So if you're ever out this way, let me know. Jack Krupe is not joining us, so I'll give you his brief bio. So he's been investing in both real estate and distressed debt since 2001. He built long-term relationships with experienced real estate developers, sponsors, and syndicators over his 20-year career. Jack was extremely active during the 2008 financial crisis as part of a private equity fund buying distressed and restructured debt, and made great returns both acquiring and repositioning properties, as well as modifying and restructuring loans to create win-win situations for those borrowers. In 2014, Jack entered into a partnership with a large private equity fund and led the asset management arm of the firm that made over $3 billion in purchases of non-performing and reperforming mortgage debt between 2014 and 2019. So looking at our experience on a timeline, starting in 2001, Jack started buying real estate focusing on single-family and multifamily rentals. Then in 2008, he joined a New York City private equity fund, which was buying distressed mortgages from banks. In 2010, he launched Gemini Capital Advisors, and in 2014, partnered up with that large private equity, as I mentioned earlier, and made over $3 billion in purchases of non-performing and reperforming mortgage debt between 2014 and 2019. And then in 2019, Jack and I launched the JKAM Diversified Fund. So the JKAM Diversified Fund gives passive investors the opportunity to achieve diversification, access to projects that are almost always off market, and participate in the tax advantages of real estate. So the fund was born out of the need to solve some of the roadblocks passive investors face, which included the time it takes to source, review, and underwrite deals, achieve diversification among projects, operators, and geographies with a low minimum all in one fund. And thus the JKAM Diversified Fund was born. So looking at the realities or problems passive investors face when investing in real estate. So number one, the first is knowledge. So you have to know how to evaluate real estate, if it's a good investment or even meets the objectives of your investment goals. You need to be really knowledgeable about what asset classes to select, whether that is single-family rentals, multifamily rentals, commercial real estate, ground-up construction, value add, what locations and geos, or which operators, et cetera, et cetera. Like the list goes on and on. So this makes this really challenging if you're trying to do this passively. The second is the time it actually takes. Real estate investing is not easy, and it takes a ton of time. To do it effectively, you'll need to network and source opportunities, analyze and evaluate the opportunity, source the capital to fund the project, and have the right team in place to execute on the strategy, and much more. And after spending all that time working through the processes that you need to have in place to be successful, you may only end up with 1 or 2 projects. And that leads to the third common problem, which is diversification. Most real estate investors get burned because they rely too heavily on one rental or one real estate syndication project. And when there's a bump in the road with a tenant or an operator, your return on investment is really impacted because you only have 1 or 2 investments. So diversifying among larger, more stable asset classes like multifamily syndications is also challenging because of the higher minimum investment requirements. Most are around $50,000, and this means that you'd have to have a significant capital outlay to achieve diversification, not just among operators, but geographies and asset classes. So the purpose of the JKAM fund is to provide the solution to those 3 major problems. Number 1, with our experience and expertise, you can participate in quality, stable, risk-averse projects that are hard to source if you're not in the industry. Number 2, as an investor, you get a completely turnkey real estate investment. This means that you're not dealing with tenants and toilets, the time it takes to source and evaluate opportunities, completing the paperwork for each project, dealing with many or multiple different payrolls during tax time. And lastly, the third, which is turnkey diversification. With a single investment into our fund, you'll be diversified across best-in-class operators, projects, geographies, and real estate asset classes, providing you with the advantages of real estate, which are higher returns, cash flow, and tax advantages. The JKAM fund does the due diligence you don't have time for. So like operator due diligence. We meet with operator multiple times to establish a relationship or expand on long-term relationships. We evaluate their experience and track record. We review the teams they have in place, including their construction and property management partners. We also do on-site visits to meet the property management teams in person. These best-in-class operators review hundreds of opportunities and bring us only a handful, which we take a closer look at before co-investing. The operator also does a pretty significant amount of market surveying as part of their due diligence. And lastly is close communication with the operators. If we have questions or concerns, the operators that we invest with are extremely responsive. The JKAM fund has the partners and team in place for success. We utilize Strategic Fund Services as our fund administrator and accounting. The JKAM fund will be audited by DeJoy, Knopf, and Blood LLP, which is a member firm of the BDO Alliance. We use Syndication Pro as our investment platform, which provides our investors a portal for viewing fund updates, tax documents, current fund holdings, and all fund documentation. We use Fisher Broyles as the law firm to form our fund, which is a Reg D 506C. And lastly, our fund holdings are verified through Verivest, providing you with a peace of mind that we are actually invested in what we say we are invested in. So as I mentioned earlier, one of the benefits to our fund is diversification, and the overall fund asset allocation looks like this. 75% of the fund is in stable multifamily projects that are fully occupied and have positive cash flow. 20% is in higher return projects like ground up development projects, specifically senior housing, and 5% is in higher returning transactions like non-performing loans, reperforming loans, and REOs, where Jack and I have a significant experience from the last fund where we managed a portfolio of over 30,000 loans, which at the time was over $3 billion in value. Again, here are the asset classes the JKAM fund invests in: multifamily value add, housing development, and loan acquisition. Multifamily value add makes up the lion's share of the fund because of the stability in booms and busts, and it has current cash flow and upside potential. So these are 100 plus unit buildings with on-site property management in strong and growing secondary markets. They are Class B, which is right in the middle and has strong demand whether the economy is in a recession or a boom. These Class B assets are typically 20 to 30 years old, and the value add strategy is to renovate units as leases turn over and improve property amenities, creating the opportunity to increase rental rates and the value of the building. As we've seen recently with the pandemic, there's been a massive migration out of cities and into these secondary markets where there was already limited housing supply, and this migration has really further amplified the demand for this type of housing. The JKAM fund invests in ground up housing developments like senior housing because of the higher cash on cash after 24 months and the high IRR upon exit. So these are 100 plus unit independent and assisted living facilities which will meet the need and demand for the aging population. So these independent and assisted living facilities are constructed with designs to better mitigate the risk associated with the pandemic. So for example, they have better heating and cooling infrastructure, wider hallways, and et cetera, like things like that, so that they're producing a better product that is able to deal with pandemics, as that seems to be something that they need to plan for going forward. The last here is loan acquisition. Loan acquisition is opportunistic and will only make up about 5% of the fund's capital allocation. Jack and I have significant experience managing over 30,000 loans at our last fund, and we can execute on mortgage debt acquisition, management, and disposition to achieve high returns. Thus far, the fund has made investments into 12 multifamily projects, 1 senior housing project, and 1 REO loan pool totaling over 2,000 doors in 7 emerging markets and 7 states. Ultimately, the fund will likely make investments into as many as 15 to 20 multifamily projects and 2 to 3 senior housing projects. This is just a snapshot here of all the different properties that we have. Here is a snapshot of the project locations thus far. So primarily southeast, southwest. So moving on to the depreciation and tax benefits. So depreciation, one of the key benefits of real estate investing is the depreciation of the buildings, which passes through to the investors of our fund and can offset the taxes on returns that our investors earn. The way that this is done is by cost segregation. So our operating partners complete a cost segregation study, which allows for the depreciation benefit on the properties to be accelerated. The depreciation on the JKAM multifamily assets in year 1 has ranged between 50 and 90%. So for example, our Jacksonville project received a $462,000 depreciation benefit on a $500,000 investment. So the JKAM fund expected net return is a 15% plus IRR, has a minimum investment of $50,000 and a preferred return target of 6 to 8%. There are 4 share class options in which you can participate in. The 2 equity options are as follows. Class B pays a 6% preferred, 70-30 split, and has a $50,000 minimum. 70% goes to the investors, 30% goes to the fund managers. Class E is an 8% preferred, 70-30 split, and a $250,000 minimum. The fixed share class options are a 10% preferred, has a 3-year term and a $50,000 minimum. And Class D is a 12% preferred and has a $250,000 minimum. So here we'll be outlining what a $100,000 investment looks like in the equity share class B. So say you invest $100,000. In year one, you receive a preferred of 6% or $6,000. The same in year two. And in year three, as there are dispositions or exits from some of the projects, we'll start returning capital or principal. And in this example, we return $50,000. So you'll receive your $6,000 plus $50,000 of your initial capital. In year four, you get $3,000 in pref, which is 6% on the remaining $50,000 of capital you have in the fund. Plus, we'll also return an additional $25,000 of capital. In year five, you'll receive $1,500 or 6% on the $25,000 you have remaining in the fund. And you'll also receive the last $25,000 of your capital or principal invested. And in the sixth and seventh years, you'll get 70% of the profits after all capital and prefs have been paid. So ultimately, this works out to a 15% IRR, which we are trending well above based on the current projections in the fund. So for those of you not familiar with the term IRR, or internal rate of return, it is the annual rate of growth that an investment is expected to generate. So if you'd like to see more detailed information on the fund offering, you can go to jkaminvestments.com/offerings and see more detailed information there. Thank you for joining us today. And looks like we have a few questions here. So those next. Looks like we've said, there's a question, how are your fees calculated into the split? I'm assuming that you mean the 70-30 split on profits. So we've got a 1% acquisition fee and a 1% management fee. So after all capital and principal has been returned, after all pref has been paid, then we pay or distribute the profits 70-30. So I'm not sure if that completely answers your question there, Carlos, but I'm happy to dig into that offline with you if you like. Do we have any other questions, guys, while I'm here? All right, awesome. So again, if you guys have questions that come up later, feel free to reach out to me at wbenati@jkassetmanagement.com. You can also reach out to Jack at jkrupi@assetmanagement.com. I'd encourage you to visit our website. That's jkaminvestments.com. We got a bunch of content on there. We've done a bunch of webinars as well. So it's a great resource for you guys to find out more about us if that's of interest. I want to say thanks again to the Verivest team and your platform. I think it's a really great resource for those that are investing in private real estate market. Thanks again, guys, and have a great day. See ya.